Good afternoon, everyone, and welcome to the AASB webinar covering the proposals in ED 295, the Simplified Disclosure Standard for Tier 2 entities. We thank you for taking the time to join us, especially given this must be a busy time of the year for many of you. Let me introduce your presenters today. My name is Carla Kandaya, and I am the Technical Director of the AASB. Today, I'm also joined by Mina Rose, one of our Senior Project Managers. Before we start, a few housekeeping matters. I hope all of you can hear us as well as see the slides. You should be able to see the control panel on the right-hand side where you can put up your hand or ask questions. You should be also able to see and access two handouts. The first being the key facts paper summarizing the proposals, and secondly, a PDF of the actual exposure draft. Both of these documents are also available on the AASB website. The slides will be available on our website after this session. Now, let's see what's the agenda for today. During the next hour, we are going to explain to you what we are proposing, why we are doing this, and what this may mean for you. We would like the session to be as interactive as possible, even though it is a webinar. And while we have a Q&A section towards the end of the webinar, if you have any questions as we move through the content, please raise them. You should be able to ask a question. You should be able to see Ask a Question section on the right-hand side of your screens. We will try to answer as many of them as possible as we move through, but with such a big audience, that may not be possible. So if there are any questions that aren't answered, we will come back to you offline after the webinar. We have also prepared several polling questions throughout the session. They will appear on your screen as questions with multiple choice answers. Please select one when they come up. Now, before we get further into the details, to help us better understand today's audience, it's now time for our first polling question. We are keen to understand how many of you are preparers, auditors, users, or others. So if you can just choose. Okay, almost 80% of you have answered. All right, so I will now close the polling and share the results with you. So there are about 56% of you that are preparers, 16% auditors, 7% users, 12% technical advisors, and 10% of others. Now, if I move on to the next slide. Now, the objective of today's session, as I mentioned, is to provide you with an overview of the proposed new disclosure standard, explain how we have developed it and what it means to you. In particular, we will explain the major differences to the current reduced disclosure framework. As I mentioned, we are very keen to hear from you, so we encourage any and all feedback, either throughout this session or via response to the survey you will receive at the end of this session. So what are we proposing? We are proposing a new standalone disclosure standard, fully replacing all of the pure disclosure standards in the Australian Accounting Standard Suite, such as AASB 101, 107, AASB 12, AASB 7, and AASB 124. And these new proposals will also replace the current reduced disclosure regime. So we will not be retaining the shading in the current standards. Entities will still need to comply with full recognition and measurement, but with much reduced disclosures. Also, these disclosures will also be much reduced compared to a recent proposal that was exposed, ED 277, a couple of years ago. Now, if I move to the next slide, who will these new proposals apply to? So all Tier 2 entity, which means all for-profit private sector entities that do not have public accountability, including all of those that are currently doing special purpose financial statements, but are required by legislation to comply with Australian accounting standards or accounting standards. Also, those entities that are required by their constituting documents to comply with Australian accounting standards unless they are grandfathered or exempted. Not-for-profit entities that prepare reduced disclosure requirements, general purpose financial statements. So if you're doing RDR currently and you're a not-for-profit entity, if these new proposals go up, then there will be no option to continue with RDR. You will then have to move to the simplified disclosures. Other entities that will be caught in the scope of the proposals are public sector entities other than government entities, unless the relevant regulator requires Tier 1 general purpose financial statements. Now with that, I will now pass on to my colleague Mina Rose, who will take you through the rationale of the proposals.
Thanks, Carla. So why did we make the proposals? Well, first and foremost, the AASB had to find a solution for-profit private sector entities that can no longer prepare special purpose financial statements when there's the ability of lodging special purpose financial statements with ASIC is removed under the proposals in ED 297. So that obviously goes together, and some of you might have listened into our webinar this morning on this. If not, and you are interested in those proposals on the removal of special purpose financial statements, the webinar is available on our website, I believe later on today, so as a recording, so you can listen to it at another time. So the feedback from the post-implementation review of the RDR disclosures that we received previously was that RDR hadn't really delivered the outcomes expected and wasn't really enough a reduction in disclosures that it was worthwhile for people to adopt. The take-up of RDR was quite low. There had been then an attempt to revise RDR disclosures subsequently in ED 277, as Carla mentioned, and that was sort of a taking a more principle-based approach to identifying RDR disclosures, which involved sort of identifying key disclosure areas, but again, that still ended up with way too many disclosures. And the reason for that is partly, I think that the RDR uses a top-down approach. So as a general rule, it was always top-down. So we always started with the full disclosures and then try to identify disclosures that could be removed. That also had the disadvantage that we had to retain the complex language that is used in full IFRS standards. ITC 39 then had a completely different approach and proposal. So in ITC 39, and that's a discussion paper that preceded the exposure draft to remove special purpose financial reporting. In that discussion paper, the board proposed to make mandatory those standards that are already mandatory for special purpose entities at the moment. So that's the presentation of financial statements, cash flow standard, accounting policies, and the additional disclosure standards, and then also 4 standards that were considered essential, and that was the revenue standard, tax, impairment, and related party disclosures. So those standards would have been mandatory. All of the disclosures would have been mandatory, but none of the disclosures from the other standards. So the feedback that we received there was that stakeholders didn't really like that either, because they said it wasn't really finding the right balance. And one way, it was way too much disclosures. So for example, revenue standard has very detailed disclosures, which would all have been required, similarly impairment in particular. On the other hand, disclosures were missing, so like provisions and liquidity related disclosures. So that meant we had to go back to the drawing board, because obviously, first and foremost, we had to find a solution for those entities that have to step up from special purpose reporting. So we had to find something that balances user needs with cost to preparers. And an obvious candidate here to look for is IFRS for SMEs, because that standard is obviously written for entities that don't have public accountability. So it's similar user groups to the companies that we're talking about here. And while the majority of our stakeholders did not support adopting using the simplified recognition measurement requirements from the IFRS for SME standards when we reached out last year as part of RTC 39, that does not mean that we can't use the disclosures and that the disclosures can't be useful. So, and that also goes together with the AASB's overall objective to always maximize the use of IFRS-based material. The other bit of information that is useful here is that the AASB actually has a project right now that is called IFRS for SMEs for subsidiaries. And that project is investigating whether it's possible to adapt the IFRS for SMEs disclosures to use with full IFRS recognition and measurement requirements, which is essentially exactly the same what we're doing here. So this goes in line with the AASB strategic objective to use IFRS-based material. So ultimately, obviously, the hope is that if the AASB goes ahead with this project, that we can then, in the long term, adopt that standard here for use as well. And we are liaising with the AASB staff in the process and in terms of discussing issues as they arise as well. So how did we then go about this? So as I said, we started with the IFRS for SMEs disclosures. And the overall objective was to keep the differences at a minimum. And that's also consistent, again, with the AASB's objective for their project on IFRS for SMEs for subsidiaries, to really try to stick as closely as possible to the IFRS for SMEs disclosures. And that has certain consequences, as we will see later on in this session. So then we had to obviously look at the R&M differences. And first of all, there are certain recognition measurement requirements in IFRS for SMEs that are not available under full IFRS or are not applicable. So for example, under IFRS for SMEs, you amortize goodwill. So there are certain disclosures in relation to the amortization of goodwill, which you obviously don't need. Then there is quite a number of undue cost and effort exemptions where you might have to disclose if you have adopted that. So those disclosures we have obviously taken out. We then had to look at where we had significant R&M differences. And the two most obvious standards were revenue and leases, the most recent standards. So what we did there is we sort of looked at what's the ultimate outcome and what is recognized in terms of the recognition of items in the financial statements. And for example, for revenue, what we realized, while there's vastly different principles that are applied in revenue recognition, ultimately under IFRS for SMEs, you have revenue from the sale of goods, revenue from services, and revenue from construction contracts. The main difference between is they are recognition at a point in time versus over time. So that's really no difference to IFRS 15 or AASB 15. So hence we concluded that while we have different principles of revenue recognition, overall the level of disclosures that is in IFRS for SMEs in terms of revenue should still be applicable and relevant for our standard as well. So we retained the level of disclosures, but we adapted the terminology to fit with the new standard. And similarly for the leasing standard. So if you think about finance leases and compare that to the accounting for leases under AASB 16, under AASB 16 you recognize a right of use asset and a lease liabilities. That's not any different to finance leases. So we then therefore used the finance lease disclosures and again changed the terminology so it fits with AASB 16, but retained the level of disclosures. And we said there's no need to provide any more disclosures. Similarly, for any exemptions under AASB 16, for example, for short-term leases or low-value leases, we said that's like operating leases, so we use those disclosures there. So that's for the R&M differences. We then also had to obviously add some disclosures where there's actually differences. For example, under Australian accounting standards, you have indefinite life intangible assets, which you don't have under IFRS for SMEs. So there's certain disclosures coming out of that we then had to add. We also added not-for-profit and public sector specific disclosures because the board had decided that there was no point developing a disclosure standard that would only be relevant for for-profit entities and private sector entities if this is actually providing a relief from disclosures, and this standard should also be made available to all other entities as well. Ultimately, also, we did not want to have 3 different disclosure frameworks next to each other, so fully was RDR and simplified disclosures. So we then had to obviously add disclosures for the not-for-profit and public sector. And what we did there is that we looked at the principles that the AASB has used when they identified their IFRS for SMEs disclosures, and then tried to apply them to the not-for-profit and public sector disclosures. Ultimately, we ended up with basically retaining the disclosures as they are there at the moment in reduced disclosure. So there's no changes. But what we have done, or what will happen, what is part of the proposal, is that all disclosures are now in one standard. So you really have a one-stop shop. That standard will, if you are a tier 2 entity, all you need to do is, in terms of disclosures, is look at that standard. You don't need to look at any of the other standards. So that should make it a lot easier to apply. Finally, we also had to add some disclosures for Australian-specific disclosures, such as basis of preparation, etc. And the board decided to make the disclosure of fees paid to auditors mandatory.
Mine, before you move on to the next slide, there are a couple of questions. One is whether we know the timing of the AASB's project for IFRS for SMEs for subsidiaries.
So they are right. That's a very good question, Carla. They're right at the moment at the beginning of the journey. So they don't have a fixed timeline on their website yet. It is at the moment a research project, but they're certainly progressing it. And Chris Peach, our chair, has actually been asked to present to the AASB in December about our experiences as well. So.
There is another question where someone has asked, what does the level of the graphs represent? And they don't represent anything.
No.
They're just there for aesthetics.
Sorry. Yes. Okay. So what does this mean for you then? So as we said, it does mean a considerable reduction in disclosures compared to RDR. And if you have a look at the handout, so the handout, the key facts handout will list you the specific disclosures that have been removed. Now, whether or not it really means ultimately to your specific entity a considerable reduction depends on your entity. So if you have a fairly simple entity with not very complicated transactions, maybe only trade debtors and no complicated financial instruments, no subsidiaries and no joint ventures, it might not mean that much. However, it really depends on your entity and on the type of transactions that enters into. One other thing that it will allow, though, IFRS for SMEs has an option of not presenting a separate statement of changes in equity. And that applies if the only changes in equity that you have are your profit or loss for the year, any dividends paid, changes in accounting policies, and restatements, for example, as a result of errors. If you don't have any more changes in equity in a year, then you don't need to present a separate statement of changes in equity, and you can just reconcile down from your profit or loss. However, if you do have reserves, for example, or any movements in share capital, then that option is not available. But it might be something that is of interest to some entities. And this is one of the areas where we will want to get some feedback too. So we will have our next polling question in a minute on this. But before we get to the polling question, just briefly, so as I said before, there is also disclosures that are actually added to RDR. And this comes because the overall principle was we will follow IFRS for SMEs. So wherever IFRS for SMEs had more disclosures, we actually retained them at this stage. But again, this is also something where we are looking for feedback, and we'll be interested to hear, and we will go through those disclosures in more detail later in this session. And finally, if you are currently doing special purpose financial statements, it will obviously mean a step up in disclosures. That's unavoidable. Certain things like related party disclosures, tax you will have to put in. However, there's also positive news, because certain disclosures that you currently have to make, like a reconciliation of cash flows, your operating cash flows, a third balance sheet if you have restated information, and net debt reconciliation that is required under AASB 107, the cash flow standard. Those disclosures you will no longer have to provide. So there's some good news there as well.
Okay, with that, we'll take you to our next polling question, which is on the statement of changes in equity, and whether you think that Tier 2 entities should be given the option of not preparing a statement of changes in equity. Can you please give your answer yes, no, or if you're unsure? And for those that are unsure, can you please provide some more information on why, and what else do you need to make that decision?
At the end, so you won't be able to, in the survey, obviously you only have 3 options, but in the end, in the polling question, at the end of the session, there will be a survey, and if you have any further information on these, if you explain to us why you're unsure or what you would need from us to help you make a decision, please let us know. That would be great. Okay, we might close the polling session now.
So we've got 60% who think, yes, there should be an option of not preparing the statement of changes in equity. 36% say no, and 5% are unsure.
That's good. That is very consistent too with our roundtables that we've just held, where there was also some mixed views, and I think some felt that it probably wasn't worth the effort of having to change the format every year. But it is certainly something that's good for us to know, and it's also feedback that we will share with the AASB as well. Okay, so we move on now to the main reductions in disclosures compared to RDR. So you will find that the main benefits in the reductions are in the newer standards, and that's, I think, because that's in particular where the disclosures became more intricate when the AASB drafted the disclosures, and where this top-down approach that we've used in the past, where you had to shade, or we had to shade disclosures to remove them, didn't always work particularly well, and maybe made us retaining too many disclosures. So what you will find, for example, in AASB 15, a lot of the detailed suggested disclosures have been removed. So because we are starting bottom up now, so we're just looking at IFRS for SMEs and what does IFRS for SMEs require, and that is all that is necessary. That doesn't mean that you might not have to make some of those disclosures, because there is still an overriding requirement to disclose significant judgments or estimates made, for example. And there's also an overriding requirement to provide any information that is relevant to an understanding of the financial statements. So some of that information that is currently listed in those often appendices as well, you might still have to provide, but I think you will find that the disclosures will be made at a much higher level, and because we don't have that checklist to go through, it's a higher level disclosure. Financial instruments, in particular, I think that's where I find the new approach is particularly beneficial, because we get away from the quite technical language in AASB 7. And there has been some rebalancing in those disclosures. So you will see on the next slide that there's also some disclosures added, but I think ultimately the disclosures where we end up with are more appropriate and more directed at this type of entities. So I think it will be hopefully useful. In terms of interest in subsidiaries and joint ventures, so there is still a requirement to disclose parent-subsidiary relationships. That's the same requirement that is also in the related party standard. But the detailed disclosures that are required under the AASB 12 standard will not be required. There's also some detailed disclosures have been removed from business or will not be included that are currently required under the business combination standard, for example. We already talked about the option not to include the statement of changes in equity. And then other disclosures that have been removed is, for example, a requirement to disclose individually material items of income and expense. That is no longer required. However, as I said before, there is still a general requirement to disclose any information that is relevant to an understanding of the financial statements. So if you had a transaction that was really material and without explaining this transaction, it would not be possible to understand the financial statements. You would still have to disclose that, but that sort of default of disclosing individually significant items of income and expenses is no longer there. The next item on that bottom right-hand box is actually the interesting one that generated a fair bit of discussion at the roundtables as well, and this is the income tax reconciliation. So with that one, obviously, IFRS MES has tax disclosures, and you have to provide a breakdown of your temporary differences by type of temporary differences. So that will stay. And you also have to disclose significant differences between your prima facie tax, which is your accounting profit times your applicable tax rate, and your tax expense. But you can do that in narrative form. You do not need to disclose a reconciliation as you have to do under AASB 112, for example, and as listed companies have to do. So this at the roundtables, we had a fair bit of discussions on that, and there were quite mixed views. Some people felt that this information is relevant and should be provided because it highlights, for example, errors and potential errors in the tax information. However, others felt that's really an audit issue, and while auditors would want to see and audit that reconciliation, that doesn't mean that you necessarily have to disclose it. So in a minute, we will have another polling question where we would like to get your thoughts on this particular question as well. But before we move on, I should round up with discontinued operations, which is another area where you see less disclosures, because under IFRS MES you do not have to separately present assets and liabilities relating to discontinued operations on the face of the balance sheet. So you still have to disclose your profit or loss in a attributable to a discontinued operation in a single line item in the profit and loss statement, but you also don't have to restate your comparatives. So less disclosures there. We have a question.
Mina, before we go to the polling question, there is another question more about comparability and the option to not provide statement of changes in equity. So the question is, how does making it optional help make financial statements comparable across entities? I suppose, Mina, isn't it that the option not to provide the statement of changes in equity only in limited circumstances?
Yes, it is certainly only in limited circumstances. So no information would be lost. So if you have reserves, so if you have movements in equity that are and would not be disclosed if you choose this option, then you can't basically choose this option. So you can only choose this option if the only thing you have is profit or loss, dividends, or restatement of retained earnings. Otherwise, you cannot use that option. So, but it certainly, and that was one of the feedbacks we had too in the roundtables, that some people felt that users might look for that statement of changes in equity and might find it confusing if it's there sometimes and if it's there not at other times. So it's a good question.
Okay, now if we'll move to the polling question. And as Mina mentioned, this is on the tax reconciliation, whether a tax reconciliation should be required or not. So if you can provide your response.
Okay, we might give it 10 more seconds and then close.
Okay, so we will close the poll now. We have about 77% who have responded. So it's interesting feedback. So 58% say the tax reconciliation should be required. 37% say no, it shouldn't be required, and 5% are unsure. That's interesting results, Mina.
Good. Yeah, that's it's all good feedback, and it's certainly, as I said in the roundtables, it was similarly mixed. So something again that we will take back to the AASB when we go in December. So that's good. Thank you. So now to the increased in disclosures. So as I said, in terms of financial instrument disclosures, there's been a bit of a rebalancing. And in particular, the hedging disclosures. So a lot of disclosures have been taken out, and it certainly means you don't have to work your way through your disclosures in AASB 7 and try to work out what has been shaded and what hasn't been shaded. But one of the disclosures that has come in is in terms of cash flow hedges, the periods when the cash flows are expected to occur and affect profit or loss. And I feel that's probably actually relevant disclosure, and I must admit I don't know why that was removed under RDR, but that's certainly one that comes in. The other thing I should mention on this slide, you see some disclosures in red font, and so some of the disclosures are actually in addition to disclosures that are required under full IFRS, and that is for various reasons. Sometimes it's because the IFRS for SME standard was written at a time before the standards have been revised, the full IFRS standards, and may have referred to old disclosures and used old disclosures. At other times, they might have been written where standards were intended to be maybe revised, and it was expected that they would have the same disclosures, but that didn't go ahead. So one of the things, for example, in the hedging is fair value hedges. So under IFRS for SMEs, you need to disclose separately the amount of changes in the fair value of hedging instrument and the hedged item. Whereas under full IFRS, all you need to disclose is the net hedge ineffectiveness. So whether you really need to have the gross amounts, I don't know. But again, this is something area where we really would like to get your feedback, whether it is worth sticking with the principle, follow IFRS for SMEs under all circumstances, or whether we should, the AASB should reconsider that and say we follow IFRS for SMEs except where it increases to above full IFRS. So some of the other areas where there is additional disclosures is in the defined benefit plans, for example. There's quite a bit in that actually, and I think that's because probably IFRS for SMEs was written at a time when there were proposed revisions to the IS 19 which didn't go ahead possibly. So we have a disclosure there for long-term benefits and termination benefits where under IFRS for SMEs you must disclose the funding, how those benefits are funded, which is not something that you need to disclose under full IFRS. Similarly, IFRS for SMEs, where you have a group plan, so you have a consolidated group, and you have one entity that has the defined benefit plan. Under full IFRS, you can refer to those financial statements for the disclosures, and that's not permitted under IFRS for SMEs, so you then have to actually copy those disclosures. Other disclosures are a couple of sort of business combinations and goodwill, and also information about the entity domicile, etc. And the audit fees, as I said, that the AASB specifically, our board specifically felt should be added in terms of transparency and to assist with identifying possible auditor independence issues as well. Finally, the top right-hand side, the leases. So that's another interesting area, and that has generated some discussions at the roundtables as well. So with the leases of lessees, at the moment under AASB 117, so the old leasing standards, there is a requirement even for RDR entities, so even for Tier 2, to disclose a maturity analysis of future lease payments. When AASB 16 came in and IFRS 16 was developed, that requirement was removed from the leasing standard because the AASB said, well, there is already a requirement in AASB 7 or IFRS 7 to disclose a maturity analysis. So the leasing standard just refers to the to IFRS 7 for that disclosure. However, in AASB 7, that disclosure is shaded. It was always excluded for RDR entities, which is consistent with IFRS for SMEs, I must say, because in IFRS for SMEs, there's actually a difference. So for leasing liabilities, you must disclose a maturity analysis of the future lease payments. But when you go to your financial liabilities, there is a general requirement that just says you must disclose information about the terms and conditions of the financial liabilities and borrowings. And it then goes on to say, such as maturity and repayment schedule. But it doesn't very specifically say you must disclose a maturity analysis, and certainly it doesn't give you any time frame of those disclosures. So, as I said, that issue created a fair bit of discussion at the roundtables, and we will in a minute ask for your thoughts on this particular issue as well via the polling questions. So I think we'll move on to the polling questions now.
Yes, so if you look at your next slide, the question is about these additional disclosures. Should the disclosures go beyond the IFRS or AAS? What's your view? There are also some specific questions about that, which we can answer shortly.
Yeah, so we will just go in this first question. Really just want to get your general view whether we should stick to the principle of following IFRS for SMEs no matter what, or whether you think that we possibly should change and say you stop at full IFRS disclosures.
Okay, so we've got about 80% who have responded. So I'll close the poll now and share the responses. So interesting, and I think the feedback is quite similar to what we heard at the roundtables, where 20% say yes, just stick to what's there, and whereas about 75% say no, and 4% are unsure. So there is a question here where one participant of the webinar has said that having additional disclosures and that are not in full IFRS seems inconsistent. So that's where the AASB will see the responses from the stakeholders to the proposals before deciding which way to proceed, whether to stick with the IFRS for SMEs disclosures as they are, or to actually do something a bit more specific. And also, Mina, we will also communicate this with the AASB staff as well, so that they can also take that into consideration.
Yeah. So ultimately, I mean, that's obviously something for the AASB then to consider in their project as well. And if they should, they might decide to change those disclosures as well, hopefully, ultimately. But obviously, we don't need to wait for them, and we can make our own decision here as well. So, so it's good to get this feedback. That's great.
Okay. And then we have another polling question, which is on the disclosures on maturity analysis. So currently in the simplified disclosures, the question is, should the disclosure of maturity analysis be required only for lease liabilities, or should it be required for both lease liabilities and other financial liabilities? And lastly,
should it be for none of them? So basically, if it's none of them, that means you would only have a general requirement to disclose information about maturity and repayment schedule as it is currently for financial liabilities.
We did hear feedback from our roundtables that some people felt that there needs to be consistency. So if you're requiring for lease liabilities, then you should require for others as well.
Yeah, whereas others thought we should stick to the IFRS for SMEs disclosures, and if they differentiate, then that's okay as well. So certainly here again, some mixed views on that, but
so we'd like a few more of you to respond, at least at 70% or more, so that we get some good feedback on this.
Okay, we'll close it then. So
we've got 16% who have said that only require the maturity analysis for lease liabilities, whereas 51% said it should be for both. 29% say none, and then 4% are unsure.
Okay, thank you. That's great.
So now I'll move on to the next polling question, which is on audit fees.
So this is a disclosure. So this is not an IFRS for SMEs disclosure. This is something that the board decided should be required. But again, we have posed this question at the roundtables, and we therefore would also wanted to get your thoughts on this as well in this forum. So do you feel this is disclosure that should be made or not? Okay, a couple more seconds, and then we'll close this. We might close this now.
So we have 73% that say that they do want the audit and non-audit fees to be disclosed. 25% no, and 2% unsure.
Thank you. So we now move on to our timeline.
And just now there was a question about the proposals and when the final decision will be made. So Mina, when you talk through the timeline.
Yeah. So this is obviously still a proposal. So both this proposal and ED 297 at the moment are exposure drafts. The common deadline is 30th November, so there's still time for submissions. It was initially, if you look at the ED, it was 15th of November, but in response to feedback received, the board decided to give 2 more weeks, because acknowledging that it was the busy season and really lodgement deadline for a lot of companies was 31st of October. So, as I said, another couple of weeks to provide submissions. But what the board has said, this will be a hard deadline this time. So while we have in the past often accepted submissions after the closure date, we will not do that this time. We cannot do that because the staff does need the time to go through the submissions, analyze them, do further outreach. Quite often we find that we will have further discussions once we have received the submissions. We need to prepare the board papers, and we'll take the feedback and possibly a redrafted exposure draft to the board in early March. Oh, 2020, there's a typo on the slide, apologies. So of course it should be March 2020 when we take this to the board. Whether we will already get approval on a standard then, I suspect, I don't know, it might need another board meeting. There might be issues that will need to be discussed. But certainly the intention is to have a standard ready before 30 June 2020, and there will be early adoption permitted. And this is meant to also assist those entities that might need to, that might feel they should step up from special purpose to general purpose, for example, as a result of the increase in thresholds for proprietary companies, or other reasons, possibly also the SGE, the legislation. So we basically wanted to make sure that the standard is available as soon as we can, and certainly then have a mandatory application date, 1st of July 2020, which is consistent with the proposals in ED 297. So that is the timeline. We have a couple more polling questions and then a bit of time for Q&A if anyone has any questions. But bear with us while we go through the final polling questions, please. And one is just wanted to get your thoughts. So this is obviously, we've always had RDR shading, and where we you have one set of standards where the disclosures are in the relevant standards. This is obviously quite different, and different approach in Australia that hasn't been done before. So we would like to get your thoughts on whether you think this is a good way of going, having a separate standalone standard, or whether you actually like the old RDR and have it all in the other standards, the disclosures. So we'll share this for voting now.
Yep.
Okay. Just give it a couple of seconds. Okay. I might close the poll now.
So 93% have responded yes, that they do like want a separate disclosed standalone standard. 5% said no, and 2% unsure. So with that now.
With that, we have one more final question, which is really overall whether you think that we should go ahead with this proposal and actually replace RDR. And this is, again, a question that we have also asked at the webinar, and just to close this off. Okay, so we've closed the poll now, and we again have
90% saying yes, they do agree that these disclosures should replace RDR, 7% saying no, and 3% are unsure.
Okay, we have now time, for a couple of questions. So we have got a couple of questions. We'll just go through and see. We obviously, as we said before, if there's any more intricate questions, we will get back to you after the webinar. Yeah. Okay, I think one question was on the timing of the ICE. Now we have addressed that. Yes, we have addressed that question. No, the simplified standard. So one question we have received, whether one simplified standard is likely to be 300 plus pages. No, it certainly won't be. The I don't know how many pages, maybe I think 30 pages or something. So it is just disclosure, obviously. So it's not going to be a like IFRS for SMEs. It doesn't have the recognition measurement requirements. So unfortunately, you will still have to apply to the other standards or refer to the other standards for any recognition measurement. But as a general rule, if your business is pretty much as usual, generally you'll need to look at the disclosures probably more often than the R&M requirements. And for disclosures, certainly this will be a one-stop shop. So everything that you need to know will be in that standard, and you can basically apply that like a disclosure checklist, if you like.
So there's another question asking about the application date of 1 July, saying that, you know, we are already in November. So the board has considered, did consider this, but, you know, any feedback that you have in terms of whether you think that will not give you sufficient time will be welcome. What we want to tell, the reason why we are sort of trying to make this applicable from 1 July 2020 is because we also want to give the opportunity for those large proprietary entities which are still large after the revised threshold, and if they have to move to prepare general purpose financial statements, the board wants to make this simplified disclosure standard available so that those entities can also adopt these simplified disclosures, and they don't have to do RDR first and then move to the simplified disclosure, which will be quite burdensome for them.
But it's certainly, I mean, it won't be mandatory for 30 June 2020, so it will be available for early adoption, but it will then be mandatory from 1st of July 2020, so 30 June 2021 for most as the first date. And for December year ends, it won't be until 31st of December 2021. So
yeah,
that gives a little bit of leeway as well.
Okay.
Any questions we haven't answered, we will get back to you outside this session and via email.
Yeah.
And also, if you have any feedback for us, there will be a survey at the end, so you can provide us with further feedback.
So with that, we'll wrap up the session for today. Thank you very much for taking the time to attend the webinar. As Mina mentioned, if you have further feedback on the proposed disclosures, any disclosures you think should be removed, added, please reach out to us and let us know, and also provide us your views by completing the survey that will come up at the end of the session. And as mentioned in our timeline earlier, the comment period closes on 13 November 2019. So please provide us your feedback. You can write us a formal submission, or you can also send us an informal feedback via email, or give us a call, and we are happy to set up a time to have a discussion with you. And as you can see on the screen, we do have lots of technical resources available on our website, like some research papers to support what we're doing in ED 297, as well as this ED, as well as other hot topic information. So with that, thank you again, and speak soon.
Thank you for your time and your feedback.